There are many reasons why you might want to have exposure to commodities in your portfolio. One might be that you want to diversify away from equity and bonds. Another might be that you want to protect yourself from an inflationary spike driven by commodities. And a third one might be that you just want to speculate on the price of oil. Whatever the reason, we'll look at the drivers behind commodity prices so that you get a better understanding of the market itself, and also how to get cost-effective exposure to the particular commodities which interest you. Now, I'll also split it up into a section on UK funds and US funds so that you can use the chapters to scoot between the two at the end of the video. So let's look at commodity exposure in your portfolio in a bit more detail. Let's start off by looking at what commodities are actually available. We can categorize it into four broad groups of commodities, and the first of those would be energy commodities. That would include crude oil, but also the products when we take crude oil and split it up into fractions. So that would be things like natural gas, but also other refined products like gasoline. Another popular set of commodities in portfolios are things like precious metals, particularly gold, but also silver, platinum, and palladium. Commodities would also include agricultural commodities such as grains like wheat and barley, but also softs, things like cocoa, orange juice, and then finally livestock, so things such as pork bellies. And then the final group would be industrial metals. So that would include things like copper, aluminium, zinc, and tin, all of which are used for various manufacturing processes and which feed into other industries. Now, one of the things that characterizes commodities is that they tend to have fairly high volatility. And here I'm looking at their volatilities over the last 5 years. Now, remember, volatility is a typical percentage annual price move. And the funds which tend to be most volatile are the ones which are single commodity funds. So here at the top, you can see crude oil, for example, but also some precious metals like palladium. Then we have petroleum, but also other precious metals like platinum and silver. So this volatility of around 28% or 26% would be higher than it would be for, say, a global equity fund or the S&P 500. So this group of funds here would give you exposure to a broad basket of commodities, and that diversification reduces their volatility. And even for the least volatile commodity funds here at the bottom of the graph, the volatility is around 11 or 12%, and that is comparable with something like a global equity fund. So just bear in mind that commodities may introduce risk to your portfolio because they do sometimes suffer sharp falls, but also sharp rises. If we're thinking about diversification, then the correlation between these funds is very important. So what I'm showing here is the relationships, the correlations between these funds over a 5-year period. And this is for daily returns denominated in sterling. What this tree shows you is the clustering of behavior amongst different commodity funds. So for example, at the top here, you can see some precious metal funds. Here's a palladium fund, a broad-based precious metals fund from Wisdom Tree, and one that gives you exposure to platinum. They're all clustered together in the tree because these are highly correlated funds. If we look at the daily returns, we'll see that they tend to move up and down together. Then this red cluster you can see here are all broad-based commodity funds. These also tend to have high correlation. Then at the bottom of the graph, we have gold and silver, which clusters together because those two metals tend to move together with one another. But then within each cluster, you can see that the length of these nodes is very short. And that means that these are highly correlated funds. Effectively, they'll all give you identical exposure. And that's also true of these two silver funds, SSLN and PHSP. And then finally, we've got a branch at the bottom, which is completely separate from the rest of the tree. That's because these two tend to be very uncorrelated with the rest of the funds. So that includes an oil fund, PBRT, and a broad-based composite fund, UC90, which tracks a CMCI index. So the way you'd use this tree would be to choose commodities which are far apart on the tree. For example, it would make no sense to buy 2 of these gold funds because they effectively give you the same exposure. But if you choose a gold fund from here and something from the broader commodity basket, which is in red, that would give you more diversification. If you invest in commodities, it's also important to understand what drives each particular market. But the broadest categorization would be into risky commodities and safe haven commodities, which is quite a short list. So risky commodities would include, say, those energy commodities that we saw, such as oil, but also petroleum, and it would also include things like industrial metals. So generally, when you see equity sell off, usually you'll see those risky commodities sell off too. And then in the safe haven category, there's gold all on its own. That's because gold is often seen as a safe haven and as a hedge against equity when people are scared. So if we think about the drivers for the price of gold, generally a low interest rate will push up the price of gold. And that's the situation we've seen over the last decade, when policy rates from the Federal Reserve, say, have been very close to their zero lower bound. The reason for that is that gold is a wasting asset, it doesn't generate an income, so when interest rates increase, people tend to prefer treasuries, which are also safe, which generate an income, rather than gold, which doesn't. Another driver of gold, but also other commodities, is that they're priced in dollars. So in fact, when the price of gold is high, that's equivalent to saying that the dollar is weak. So a generally weak dollar is good for the price of gold, but also other commodities. And what's specific about gold, as we saw, is that it's seen as a hedge against equity fear. So when people do see a big equity market sell-off, that tends to provide a fairly short-term lift to the price of gold. If we look at energy commodities, generally those have been driven historically, at least the big surges, by supply shocks, which usually involve some kind of political instability or war in the Middle East, or as we've seen recently, an invasion of Ukraine by Russia, which is a big energy supplier. So that's a supply shock, but you can also have the price driven strongly by demand. And that in turn is driven by economic activity. So for example, during the pandemic, we saw lots of people not able to drive in their cars. That reduced demand and it pushed down the price of oil. Now, structurally over time, what we're seeing is that people are moving away from fossil fuels to renewable energy. So perhaps over many years, we'll see this link between economic activity and oil prices start to break down. But certainly for the time being, that's not the case. And the price of oil is very much driven by economic activity. Another group of commodities, which is also driven by economic activity, is industrial metals. So for example, if you look at the price of copper, China buys about 60% of the global supply. So the price of copper is like an indirect read on economic activity in China, which does tend to be fairly commodity intensive. And then on the supply side, there tend to be fairly large mines for things like copper. And if there is disruption at those mines, it can push up the price of copper over the short term. So really, to understand the price moves in these metals, you have to understand the latest news, which is going on about the suppliers. And then finally, agriculture is the least predictable of all because it depends on things such as how good a harvest was in a particular region. This can also be driven by political instability. So for example, Russia and Ukraine generate a lot of global wheat supplies, and with the invasion of Ukraine, we've seen wheat prices spike, for example. Another big driver of agricultural commodity prices is things like weather, which of course is unpredictable, and of course things like disease. So if there is a particular kind of fungus which affects a certain crop, that can push up prices because it reduces supply. So you can see why agricultural commodities are not for the faint-hearted. These are probably the least predictable of all the commodity prices. Now let's consider some of the commodity indices which are available, which let us track commodity prices. Now, if you want broad commodity exposure, you'll probably go for a fund which tracks one of these indices. I've shown 5 of them here, but these do tend to be weighted differently according to the particular index. Some will have more energy exposure, some less, but also they tend to be weighted based on supply. Now that's a contrast with things like equity indices, which tend to be weighted based on market capitalization. But as we'll see in a moment, there are also other ways in which the weightings for these different indices vary. So here are 5 of the big commodity indices, and you can see their exposure to the broad categories of commodity. These 2, for example, the Roger International Commodity Index and the Refinitiv Core Commodity CRB Index, have more energy exposure than the others, for example. So it's worth checking which of these indices your fund is tracking, and you better check that it's also giving you the exposure you want. Another factor that makes a huge difference for commodity funds is whether they get exposure via the futures market or they get direct physical exposure. Now, for something like oil, you can't put it in a bunker and store it for long periods of time. So really, you have to get exposure via the futures market. Now, this is what a futures contract looks like. You can see the description beneath me crudely, and it specifies certain things, such as the quantity which will be delivered. So in this case, 1,000 barrels of WTI crude, the time it'll be delivered. So this is the contract month, September in 2022, the location at which it's delivered, which in the case of WTI crude will be Cushing in Oklahoma, and then finally the quality of the oil which has to be delivered. And that would include things like how much sulfur it contains, its gravity, its viscosity, and lots of other physical properties. So this is why price discovery is so easy for a futures contract. You know exactly what you're going to get, where you're going to get it, and when you're going to get it. For some commodities, though, you really can store them in a bunker like Fort Knox, and that means that you can get direct physical exposure. If you buy some of a fund, the fund manager will go out and buy the physical product, gold say, and they'll put it in a vault for safekeeping. So in that case, you don't have to get exposure via the futures market, you just get direct physical exposure. So there may be some kind of storage cost if that happens, because this kind of security doesn't come cheap, but it is fairly minimal. If you do get exposure via futures, you have to consider something called roll optimization. So here's an imaginary futures market where you can see that you've got delivery at various points in time, either in 1 month or 2 months, all the way up to 6 months. And this upward sloping curve of the futures curve is called being in contango. Sometimes when there's particularly high demand for the commodity, the whole curve inverts, and that's called backwardation. But this is the usual shape of the curve. Now let's imagine that we're a fund manager giving people exposure to, say, crude oil prices. Well, in that case, we'd always have to keep exposure to at least one of these contracts. But the trouble is, if we hold on to this 1 month contract for more than a month, we'll get delivery of oil, and we don't want that in our fancy office. So what we have to do continually is to sell the 1 month contract and buy the 2 month contract. That way we're always rolling our exposure through time. But you can immediately see the problem, which is that the price of the 2 month contract, if it's upward sloping the curve, will be higher than the 1 month contract. So we're always paying this roll cost as we roll our exposure between the futures. How can we minimize that? Well, we can always move further out on the futures curve. So for example, here you can see the difference between the buy price and the sell price between the 5 month contract and the 6 month contract is absolutely tiny because the curve's flatter out there. Or we could do something smart and dynamic, such that if there are changes in these futures prices, we'll just make the best opportunity to minimize our roll cost. So for example, if the curve inverts, we'll actually go for the steepest part of the curve because the roll cost now becomes an income. So when we look at the name of these funds later, you'll see some have the word strategy in the title, some are called roll optimized, but that's all it means. You're trying to minimize this roll cost if you get exposure via futures. If you want to learn more about investing in commodities or anything else for that matter, a great way to do that is as part of our Patreon community. That way you get to vote on members only content, which only you get to see, but you also get to join our Slack application and chat to me and other members of the community and ask any question you like, anytime you like. To learn more about that, just click on the link beside me and in the description beneath me. Now let's look at some of the UK funds which give you commodity exposure. Now there are simply so many funds to choose from that I'm not going to do this by showing you slides. Instead, I'll show you how to do it yourself if you're a European or UK investor. And that's using this website, which is just ETF. So you'd start off by going to this ETF screener at the top of the screen, and then you choose ETF lists by category. Then I'd scroll down till you get to commodities here and commodity ETFs. So here it gives you not just a list of funds in which you can invest, but it also breaks it down into the indices which you can track, and then it shows you how many ETFs track each index. It also shows you the wide range of costs which you'll pay for these funds, ranging from 0.15% per year all the way up to 0.6. So this graph which we saw earlier shows you what exposure you'll get to each broad category of commodity. But then you also get for the individual indices how they're constructed. So for example, the Bloomberg Commodity Index contains 23 commodities, whereas the Rogers International Commodity Index contains 38. It also shows you how often each index is reviewed, what the selection criteria are. For example, it could be economic significance, how much is produced, in other words, how well diversified the fund is, but also how liquid each of those contracts is, because that can affect the cost of tracking the index. Some of the indices also have a cap on how much a single commodity can make up as a proportion of the whole, and that's to ensure that you don't get too much concentration into just one commodity. And if we scroll down, you can see that the price performance of these different indices does vary quite a bit, but broadly they're tracking pretty much the same thing. And if you did want to learn more about how each index is constructed, all of those fact sheets are available here on the page. So now let's look at the ETF screener, which you'll find here. And if we go to this pull down menu on the left, you can see all of the commodities funds which are listed, and there are 29 of them. Notice also that precious metals are so popular that they've got a category unto themselves, and there are actually 39 of those funds. So let's start with the commodities funds, and it's subcategorized into different segments. So you can either choose broad market exposure, which will give you those broad commodity indices, or you can focus on industrial metals. So let's take a look at the broad market funds. And what I usually do is sort by expense ratio, such that the cheapest funds are at the top. Those are usually the ones which I'd consider buying. Another important thing is the size of the fund. If the fund has been around for a long time, but its size is very small, then it could potentially get closed down. That's more of an inconvenience to you rather than a disaster. It just means you get your money back, but it is inconvenient. Now notice that many of these are priced in US dollars, so if you are a UK investor, you will have that sterling versus dollar currency risk. Further down the page, we can see that there are a couple of funds which are actually hedged into sterling. So there you won't be taking that currency risk, but you will be paying a small amount for the currency hedge. Notice also that some of these fund titles include the words such as roll select. Those are the ones which are optimized to minimize the roll cost. Another way that the title tells you that it's roll optimized is that it might use the word strategy enhanced, for example. And if you want to learn more about how the roll cost is minimized, just click on the fund description and look at the fact sheet. So if we get rid of those categories now and go back to the precious metals category, you can see the expense ratio for some of these is very reasonable, just 0.12 for the cheapest. And that may be because these aren't using the futures market. These actually store physical gold, as you can see from the name of the fund. So these will literally be going out and putting some gold in the vault when you buy some of the fund. And now let's look at some US commodity funds. So my go-to website in the US for US funds is ETFDB, which is great. And this is what the ETF screener page looks like. And again, we choose the asset class pull down and we go to commodities. And there are a huge number of funds you can choose from. Now on this website, you can actually choose whether you want futures-based or physically backed. Of course, physically backed would be something you can store, like a precious metal, say, whereas futures-based would be everything else. Also, by each of these categories, you can see how many of those funds there are for that particular category. So as usual, precious metals, lots of those funds. So let's take a quick look at those. I always sort by expense ratio from cheapest to most expensive, and you can see you get some very cost-effective funds here to give you that gold exposure. So if you want to learn more about one of these funds, say this S-Gold fund, you can just click here and you get a fund description which tells you that this gold bullion will be held in gold bars in a secure vault in Switzerland, which is audited twice a year. Not only that, but the company also posts the serial numbers of the gold bars. So that gives you further security that they're actually holding gold in your name. If you want access to a broad basket of commodities, you can choose this category here, and there are 22 funds which are available. So I'll deselect precious metals, and now you can see funds like this Aberdeen Bloomberg All Commodity Strategy. And if you choose a fund which has that roll cost optimization, it can make a big difference to your returns over a long period of time. Now, if you do want to get exposure to a particular commodity, you can also do that. So we go back to asset class here, back to commodity. So let's say you wanted to get access to palladium. We just select this fund here. Unfortunately, there's only one fund available and the expense ratio is very high. What's also useful on this website is that it tells you about the fund flows. So you can see how popular a fund is by whether money's flowing into it or out of it. So let's take a look at this Palladium fund. And if we look at the fund flows into this fund, you can see that there have been some big ones recently, presumably because Russia actually produces a lot of the global supply. So there could be a supply shock. Maybe that's what's driving people into this fund. If we look at the fund's price, we'll also see that it's been rallying recently. So let's take a look over a 1 year period, and you can see that indeed it has been rallying quite strongly recently. Now, if you do ever want to see which index a particular fund is tracking, you can just click on this link here, and it'll show you that's the Palladium London PM Fix. And if there were any other funds that were tracking the same index, we could see them listed here. Of course, in this case, there aren't any. So I hope that's given you some insight into what drives commodity prices, but also how funds get exposure to commodities, because I think that understanding is important if you want to minimize your costs. But remember that you don't absolutely need commodities. Equity and bonds do most of the heavy lifting, and they do provide most of the diversification which you'll need. Also, remember our offer from Patreon. If you do want to join our community, you can learn more about that by clicking on the link beside me, and there'll also be a link in the description. And as always, thank you for listening.